Welcome to Nerdbull1669 Weekly Trading Outlook tips for this week, 13 to 17 April 2026. Before we move to this week, right, the trading week of April 6 to 10, 2026, right, was defined by extreme volatility as the markets grapple with the shifting geopolitical headlines and the high stakes inflation data. While a fragile ceasefire provide brief moments of optimism. The week ended on a cautious note as the reality of the sticky inflation and high energy costs set in. So for the market summary of the 6 to 10 April 2026, right, the week began under the significant pressure but staged a big week recovery before flattening out. The S&P 500 managed a second consecutive winnings week, rising roughly 3.1% from its Monday's lows to finish near 6,816. So the key drivers that was actually doing this move is that the ceasefire seesaw. Markets rally early in the week on hopes of a 10-point peace plan between the US and Iran. However, gains was trimmed by Friday as Israel strike on Lebanon and the continued closure of the Strait of Hormuz sparked skepticism about the deal's longevity. So the inflation shock. So the March CPI, the March CPI report released on Friday actually showed that headlines inflation accelerating to 3.3% year on over year, fueled by a massive spike in the gasoline prices, surpassing $4 per gallon due to the conflict. So energy and tech divergence. So while most of the S&P 500 sector struggle with high costs, Big Tech provided a critical buffer. Nvidia and Broadcom actually saw gains of 2.4% and 4.6% respectively on Friday as investors favor companies with high margins and AI-driven growth. So on the commodity side, so oil, the Brent crude, right? So remain elevated near the $96 to $98 per barrel despite the ceasefire news as the infrastructure damage in the Middle East suggested that the supply would not return to normal quickly. Okay, now for the market outlook of this week, 13 to 17 April 2026. The coming week is expected to see a transition from geopolitical trading to fundamental trading as the Q1 2026 earnings seasons begins in earnest. So the now the first headline we're looking at is the rally, a relief rally versus the reality check. So while a ceasefire typically trigger a relief rally, right, the upside might be capped by persistent inflation. So investor would be watching the Pakistani lead peace talk with the US uh, VP JD Vance for signs of a permanent resolution. So if the Strait of Hormuz right, remain closed, any rally might be short-lived as the high energy prices continue to threaten corporate margins. So the next headline will be the first quarter earnings season kickoff. So focus shift to the big banks, which are expected to show resilience. Analysts forecast S&P 500 earnings growth of 12.5% for the quarter. So on Monday, we're looking at the Goldman Sachs GS reports. So watch for the trading revenue and the MMA backlog. So on Tuesday, we have JP Morgan Chase, JPM, and then Citigroup and Wells Fargo's. Look for comments from Jamie Dimon on the macro environment. So on Thursday, we have Netflix and Taiwan Semiconductor TSM. This is critical for gauging the consumer strength and the global chip demand. So the next headline will be the inflation and yields. So following the hot CPI print, the PPI production price index data early in the week, right, will be scrutinized. If the cost of production remains high, it will confirm that inflation is being passed through the consumers, likely keeping the 10-year treasury yield elevated, currently near 4.31%. So do expect a barbell market performance. High quality tech and financials may lead the relief rally, while consumer discretionary and the retail stocks right could lag as they absorb the impact of the April inflation spike. So appreciate if you could share your thoughts in the comment section on this video, and do help to like and share this video. We greatly appreciate your help. Appreciate if you can like and share this video if you find this video useful and helpful for you. Thank you for your support, and we look forward to you supporting the channel for more content. For the upcoming week of 13 to 17 April 2026, right, the macro landscape is actually shifting from a state of geopolitical panic to a data-heavy fundamental regime. So while the ceasefire provides a temporary floor for the risk assets, right, the underlying macro pillars, the inflation and the rates remain historically tight. So below is the macro snapshot for the transition into this week. So on the risk appetite, we are looking at cautiously risk on the relief phase. So the risk appetite has staged a V-shaped recovery following the announcement of the two-week ceasefire. However, this is largely viewed as a mechanical rally rather than a return to the long-term bullishness. So the squeeze, so systematic funds, the CTAs, and the short sellers has been forced to cover positions, driving the S&P 500 back towards the 6,800 to 7,000 resistance zone. So on the sentiments, investors are currently in a show-me phase. Risk on momentum is concentrated in the Asia Pacific equities, basically the EWY and the INDA and the US tech, which are benefiting from the temporary de-escalation. Under constraint, right, appetite is kept by the Strait of Hormuz uncertainty until shipping traffic fully resume, right. The energy tax on the global economy limits a full-size risk breakout. So on the rates direction, so looking at hawkish hold, flattening bias. So despite the relief rally in the equities, right, the interest rate environment remains restrictive. The higher for longer narrative has evolved into high until it breaks. So on the yield curve, the 10 years treasury yield is hovering near the 4.28% to 4.31%. While yields fell slightly on the ceasefire news, they are being held up by sticky inflation data. So on the Fed path, right, markets have significantly repriced expectation. A rate cut is no longer fully priced in until December 2026. There is even a growing 30% probability of a rate hike early next year if the energy-driven inflation doesn't really cool. The gap, a massive divergence is opening between the US, where the inflation is accelerating towards 3.5% plus, and Europe, where the inflation is nearing 2%, suggesting that the dollar, the DXY, may find support even as the war premium fades. Okay, now next on the volatility regime, looking at high compression mean a reversion. We're moving from a high volatility spiking regime to a compression regime. So on the VIX dynamics, right, the VIX actually slumped from the mid-20s towards 20, a key psychological level. A sustained break below 20, right, will signal a shift back to a normal trending market. On the gamma environment, as volatility compresses, market makers are shifting their hedging activity, which should provide a sideway to up drift for the S&P 500 early in the week. So the catalyst trap, volatility is suppressed for now, but it remains sensitive to the earnings season kickoff. Banks like JP Morgan and Goldman Sachs and Netflix will determine if the earnings volatility takes over the geopolitical volatility. So now coming to the really outlook for S&P 500. Okay, so the trend for the trend continuation, we're looking at the relief rally has actually pushed the index back towards a major structural pivot. For the short-term bullish trend to continue, right, the index must clear and hold the 6,840 level zone. So for the bull case, right, a sustained move above the 6,480 will open the doors for a retest of the psychological level. So we're looking at the trend continuation above the 7,850 level. So this would actually require the fragile ceasefire to hold and the big bank earnings, JP Morgan and Goldman Sachs, right, to provide strong forward guidance despite the energy cost. So on the pullback risk level, so the primary risk is that the current bounce, right, is a dead cat bounce within a large correction phase that started in late February. So for the minor risk, a failure to break early in the week suggests a rotation back to 6,500. So if the level 50 day period moving average, right, is breached, right, the market is likely head for a retest of the March lower lows near the 6,500. So the structural support, the absolute line in the sand for the multi-year bull market, right, actually sits at 6,000. So now coming to the Nasdaq weekly outlook. So we're looking at the strength and the failure for Nasdaq. So the Nasdaq remained the engine of this market, heavily influenced by the AI, capex, and the semiconductor cycle, primarily Nvidia and Broadcom. So for the strength above, right, we're looking at the mark that is defining the strength above level. So significantly, this has acted as the structural ceiling, rejecting more than 5 times since October 2025, which is a 26,000 level. So action, a weekly close above will validate, right, a fresh breakout. So potentially shifting the technical regime, right, from a sideways to a aggressive bullish with a targeted secondary target of above 26,000. So failure below the level represents the failure below point of the medium term trend turns decidedly bearish. So significant will be this level aligns with the November 2025 lows and the bottom of the current symmetrical triangle and sideways range. So we're looking at failure below 24,000. So action slipping below the 24,000, right, will signal a lower low on the weekly chart, triggering likely to trigger a cascade towards the 24,000, and also as the institutional conviction waver and the AI overvaluation fears take central stage. So traders note, so keep an eye on the midpoint for the Nasdaq. If we spend the first half of the week oscillating around this number, so we will expect a high volatility expansion on Thursday and Friday when Netflix and TSMC actually reports their earnings. As we move into the heavy earnings week of April 13 to 17, 2026, these four stocks, right, are the primary focus of the relief rally narrative. Below are the specific technical pivot for each and then based on the current price action and the historical consolidation zones. So for the first stock, we're looking at JP Morgan Chase, JPM. It's reporting the Q1 earnings on Tuesday, April 14. JPM actually served as the bellwether for the financial sector. It has shown strength leading into the print, trading at a slightly premium to peers. So for the bullish buyers level, right, we're looking at above $265, and sustained trading above this level will signal a breakout from the pre-earnings consolidation. If the bank raises its NII, which is the net interest income guidance for the remainder of 2026, right, look for a move towards the $280 level. So for the invalidation level, we're actually looking at below $254. A break below this support level suggests the market is actually selling the news or reacting poorly to the rising credit costs. So this would invalidate the current relief trend. So now coming to the second stock of this week, Netflix Incorporated, NFLX. So report is actually reporting the Q1 earnings on Thursday, April 16. Netflix has recently implemented a price hikes and is seeing a strong ad revenue growth, pushing the stock into the medium term bullish recovery. So for the bullish buyers level, we're looking at above $108.50. Clearing this local resistance validates the price hike tailwind. Analysts has target ranging from $115 to $130, crossing the $108.50 with volume, right, would suggest that those targets are in play. So invalidation level, we are looking at below $95. So this is the major structural flaw. Dropping below $95 will signal that the subscriber growth, right, is stalling, or that the relief rally, right, has run out of steam, shifting the buyers back to bearish. Now coming to the third stock of this week, Bank of America (BAC) is actually reporting the Q1's earning on Wednesday, April 15. So BAC has been more volatile than JPM, recently finding the firm support near the $47 before bouncing on the ceasefire news. So for the bullish buyers level, we are looking at above $53.50. The stock actually finished the week of April 10 near the $52.04. So a break above the $53.50 will clear the recent April highs and targets the $58 to $60 resistance zone. So for the invalidation level, we are looking at below $50. So the $50 level is a heavy psychological and technical pivot. A failure to hold the $50 post earning, right, suggests a retest of the $47 floor. So now coming to the fourth and the last stocks for this week, TSM Taiwan Semiconductor is reporting the Q1's earning on Thursday, April 16. TSM is actually the AI engine. So following a blowout March revenue report, which they have up by 45% year on year. So the stock is actually surging on insatiable AI demand. So for the bullish buyers level, like we are looking at above $385. So the stocks is currently testing the $373 area. A break above the $385, right, will signal that the market is pricing in the 2 nanometer N2 leadership and a potential path to $450. So for the invalidation level, we are looking at below $340. So despite the strong fundamentals, geopolitical risks remain. A drop below the $340, right, will invalidate the semiconductor super cycle momentum and suggest a deep pullback to the $310 range. Here is the market sentiment table for this week. Okay, so we're looking at the factor. The first factor will be geopolitical. The outlook is fragile ceasefire. So the impact on equity will be neutral, cautiously bullish. Then the next factor will be earnings. So we are looking at a high growth expectation, 12.5% outlook, and then the impact on equity will be bullish. So the next factor will be inflation. We're looking at a outlook that is sticky and energy driven. So impact on equity will be bearish. So under energy prices, which is the last factor, we're looking at the outlook of $95 plus on the Brent crude. So impact on equity will be bearish for the transport and the retail. So a bit of the risk management framework. So these are the three things that we should always keep in mind. So trade levels are not the opinion, and we should define the invalidation before we entry. And then Also reduce size during the consolidation. Do practice discipline and patience with. So this video is actually for educational content only and it's not financial advice. So the disclaimer, so the analysis and the result right, as you presented does not recommend or suggest any investings in the state stock. So this is purely for analysis purposes.